All right, guys, Qualcomm is a very, very popular stock. It's in the chip sector. It's one of the few that isn't absolutely overhyped right now. You don't hear many people talking about it. So, of course, we want to take a look at it and see if it's overlooked. We are value investors. Our goal is to find investments that are underpriced. Remember, news will follow the stock price. And just like stocks can become irrationally overvalued, they can become irrationally undervalued. We look at every investment as the present value of all the future cash flows. And when you buy a stock, you're buying a piece of the business. So as long as you pay a reasonable price for that business, and if the business gets better, the stock will follow pretty much in line. It's hard to sit there. If a business is able to grow at 10 or 12% a year, and you pay a reasonable price for it, your investment will probably go up 10 or 12% a year over long periods of time. In the short run, though, remember, stocks are a voting machine. So the most popular stocks are going to go up a ton. Look at it, for example, a company like NVIDIA. Is NVIDIA's company really, really worth year-to-date 178% more than it was on January 1st? Is it the fundamentals of the business? Remember, the fundamentals are different than the stock price. The stock price can go up or down like crazy. So today, we're going to go over Qualcomm. We're going to go over 8 pillars. Mo is here.
Hello.
Mo, what was that?
Hello.
Mo is our trading expert. He's going to go over Qualcomm in terms of a trading perspective. So we don't care about the fundamentals when we're looking at the trading of Qualcomm. Okay, he's going to go over that. And then we're going to go over our stock analyzer tool. The most popular part of our software. It allows us to make assumptions about the future, and it'll tell us what price to pay for the company today. Now, no matter what your range of investment experience is, whether it's very beginner or expert, there's something in this video for you. So watch the entire video all the way through. And if you have to rewatch it. This is a great process because we are trying to teach a process here. We're not trying to tell you, go buy the stock. You should never buy anything that we own or that we short or do whatever. You should find a process that works for you, and it'll probably be borrowing things from different people. So we hope you'll be borrowing things from us. So Mo, what are some major news stories about Qualcomm right now?
Yeah, so first one, Qualcomm and Samsung extend and expand broad strategic partnerships. So
oh, wow.
That's a pretty big one. I mean, it's interesting to me that Qualcomm has been so quiet.
Very quiet.
Very under the radar in everything that's been going on out there.
Look at this, Mo. The other thing is, look at the stock. It's only up 15% year to date.
It's weird. Like a couple of years ago, they were the company that was in the news. I'm not saying anything has changed. Now, has Qualcomm already beaten Apple to the punch in smartphone AI? Now they're getting to the AI chart. This is why this should be up 150% by the end of this year.
By the end of today.
All they have to do is say AI, and we're good to go.
Today, bro.
So those are two big things that Qualcomm is maybe putting themselves back in the arena of talk and maybe a little bit of hype to help that only 15% up year to date for a chip company as big as them.
Yeah.
So
that's pretty interesting. Okay, what are some, so guys, one of the other things we want to do is we want to look over some bull and bear cases. Now, what you do with that information is up to you. Remember, we want to focus on situations that affect the long-term value. So Mo, can you go over a couple of bull cases for us?
So this is actually one that's kind of been put on the back burner, is this self-driving cars, because AI is so big right now. So they've acquired Swedish automotive technology company Vonir and an Israel-based Autotalks company. So they're putting their hand in the what?
Well, remember this, Mo.
What?
This is what you just said. It's very important, guys. 2, 3, 4 years ago, it was all about self-driving.
That was it.
It was all about cannabis before. Now it's AI.
Yeah.
I want you to remember this. The hype changes from year to year.
And that's why I'm actually thinking this could be a good thing. That hype is over. Now they're going to go and quietly start to do this. And all of a sudden, maybe they're the top dog in the industry while everybody's all focused over here on something else.
Yeah, because
they're making these small acquisitions. One was $4.5 billion. One was $375 million.
Unbelievable. Okay,
Yeah.
What's another one?
Yeah. So they hold the #1 market share in the world for integrated circuits.
Yep.
And 30% of the market share in the smartphone system in the chip market.
Yeah,
That's
so
huge.
Yeah, because
I mean, Qualcomm, I remember back in the day, Qualcomm they were the smartphone chips. That's it.
yeah.
And then other people started getting into the industry.
Yeah, that's interesting because, listen, as we become more and more about wireless, Qualcomm's very big on the wireless chips.
Yeah.
I think we can all agree that wireless is continuing to be more and more a big part of the market and probably going to be the dominant force. I mean, it's wireless. No one wants to be tethered to anything, right? Yeah. All right, a couple bear cases, Mo.
63% of their revenue in 2022 came from China.
Okay, that could be a reason why.
It's heavily reliant.
We talk about Alibaba, we talk about China. And I sent you the other day, yesterday to you and Dalton, the top 10 cities in the world for new millionaires. Mm-hmm. And by the way, 2 or 3 of them look like retirement communities, so I think millionaires moving in there. Yeah. 3 of them were in China. Mm-hmm. 3 were in the top 7. Yeah. And I look at that going, okay, yes, people out there will say China's communist. Okay, I get it, but I don't necessarily believe that. Remember, even communists love money. Right. Every liberal socialist I know in the US still loves their money and still sits there and does anything possible to keep more of it.
Yes.
Everybody, you go look at the most prominent socialists and communists in history, and guess what? They live very lavish lifestyles. Mm-hmm. So I sit there and say, yes, there might be some short-term pain with China.
Yeah.
But.
And I look at this also and say, Apple was heavily reliant on China. What are they doing now? They're diversifying. Yeah. They're going to other countries, and I think they're going to figure it out. It is a bear case, but I think they're going to figure it out.
Yeah, I think it's a legitimate bear case. I mean, 63% of revenue coming from China, but if China works out for them,
it's going to dominate.
That's going to dominate.
Yes, exactly.
Okay, next one.
All right. So they make significant revenue from smartphones, and they are expecting to lose Apple as a customer by 2025.
Yeah, that's a big one.
Because Apple's going to be making their own.
Does Apple sell a lot of iPhones?
Last time I checked, I think they do.
I have one.
Yeah.
Do you have one?
I have like 3.
I know somebody in this room who doesn't have an iPhone.
Tim, me too.
He's like Rahman. He just won't do it. He refuses.
Yep.
All right.
Heels in. So those are a couple bull cases and bear cases for Qualcomm.
All right, let's look at some high-level things on Qualcomm. Okay, first off, it's a $138 billion market cap. What does that mean? If you bought every share outstanding in the market, you'd pay $138 billion. But if you want to buy the entire company, including the debt and everything, you pay $160 billion. That's the enterprise value. So the difference there is essentially their debt. 27 billion, their revenue's 41, their free cash flow is about 6.8. Doesn't seem so bad.
No, it really doesn't.
Okay, not bad. All right, PE currently is 13. 5-year PE is 19. Now, Mo, did they have a big surge in revenue because of
I would imagine yes.
So we're going to go to the income statement here.
I mean, in 2020, they were doing 25 billion, and now in 2023, they did 41 billion.
Right. So I'm pulling up their quarterly numbers to see how quarters are changing. March of 2023, they did 9.28 billion. March of 2022, 11.16. So they saw a drop here. Yeah. So remember, guys, when you're making your analysis here, I think the long term on Qualcomm is still going to be a growing business because the chip industry, the semiconductor industry, has a 12% growth rate over the next 10 years, according to some analyst report I read. What were you looking at with shock?
I was looking at their net income, the year over year net income, 4 billion to 8 billion to 11 billion to 10.5 billion.
Yeah.
That's big jumps.
So you got to sit there and say, if they got a big run up because of COVID and this big surge, what's going to happen with their revenue and their profit?
Right.
I don't know. So, dividend. Oh boy, look at this dividend yield. 2.4%, not bad. Now, guys, I want you to remember, if you're new to the channel, one thing we always discuss is dividend yield. Dividend isn't always safe. This is why we put the dividend underneath our free cash flow numbers on our main metrics, because this is the number you need to look at. Our goal is to buy a company where their dividends paid are less than half their 5-year average. Right now, it's a little more than half. Okay. Now, if you look at it, their earnings and free cash flow, they were at 2, 4, and 6 billion just back 5 years ago. Mm-hmm. But in the last, so look at that. Free cash flow last year was 6.85. Yeah. All right, so.
And even going back to 2014, 15, 7.8, 5.5 billion.
So it's probably a pretty stable dividend.
I think it's probably stable.
Okay, great. Look at this return on invested capital.
It's a big number.
Guys, this is what we look at a lot. The return on invested capital is a very popular metric amongst very, very good investors. And the reason being, the higher this is, essentially it probably shows a big moat. Why? Because the more profitable a business is, the more competitors are going to go into it. This basically says that when they invest money into the business, they get a very high rate of return on this. And it also shows that if this company wants to increase income, they don't need to invest as much money as a company with like a 10%. The market's about 9 or 10% return on invested capital. You have to invest about 1/3 of the money to get the same increase in net income and cash flow. That's a very, very big difference. This and the growth rate is the reason why you'd pay a higher premium for a company, Because if they can reinvest less money to grow now they can afford much easier this dividend. They don't have to invest as much money to grow their revenue and profit. That's a big factor. Let's go check out the 8 pillars.
I took a peek at it and I was very surprised.
Whoa!
Yeah, I was not expecting to see this.
Guys, if you belong to our software, don't forget, you can put up to 12 custom pillars in here. There's like 4 quadrillion different versions. But guys, 8 pillars. Now remember, the 8-pillar process is a way of screening things out. This doesn't mean go out and buy Qualcomm, but this is a very nice thing to see. I was not expecting 8 check marks.
Neither.
And I'm actually surprised by this.
Me too. They've been buying back shares. Let's go to their income statement.
A lot of shares.
Oh yeah, they've been buying back a lot of shares.
Interesting.
If they did, let's see here.
Very, very interesting. I think the reason why I think the China thing is probably really worrying people. 63% of their revenue came from China in 2022.
Yeah.
Wow.
Yeah, I mean, if you look over here, you can see how they've been buying back shares quite aggressively, especially 2018 and 19.
Wow.
And 2015 to 16.
Well,
so they haven't really done anything in the last
few years,
3 or 4 years, but
okay. So maybe there was a transaction that occurred that dropped their shares outstanding. Was there?
But I went here. See, they didn't sell anything off. They've
been buying stuff.
Yeah.
They've been very active purchasers in the last 10 years.
Right.
Okay. Let's go see what analysts are saying here. So they're expected to make $9.58. Oh, look at analysts, Mo. I mean, they're still looking at increases from here. Now remember, guys, analysts are analysts. They have career risk. They want to make sure they're not too far off on their estimates. They want to be very conservative. They don't want to be the extreme outlier here, right? What is that about the repurchase program?
So they're in a current repurchase program right now. It's of $10 billion. It started in 2021. I'm not sure where they're at in it.
Well, that's 6 or 7% of their shares outstanding.
Yeah.
That's a big chunk.
That is a big number.
And guys, when we look at repurchases of stock, we want to make sure that companies are repurchasing cheap stock. And right now, a 13 one-year PE is pretty low, but we have the question of, are their earnings going to sustain? According to analysts, yeah, their earnings are going to sustain. So if you believe this, we're going to take a look at it. Now, revenue. What do analysts think about revenue? They think revenue is going to decrease to $38.75 billion for this year and then go up from there. So not major growth, but pretty solid, but still growing from a very big high, right? Mm-hmm. But they're not, so, okay. That's very interesting. Mo, what's in your mind about this one? Because I see you thinking about this.
I mean, I think it's interesting. It makes me want to look deeper.
Very much so.
That's for sure. I mean, I noticed here it's on my watch list at $99, so I've obviously looked at it in the past. But this is the point where it's $124 right now. This is probably where I go and start taking a deeper look at it and start saying, hey, what am I missing? Let's look at this share repurchase program, et cetera. See the competition, see the plan that they have laid out over the next couple of years, what their plans are with China, maybe.
And Apple.
With Apple also.
So that's the thing.
Diversifying out of China.
If Apple, this is what I don't get. Analysts know that Apple is going to bail on them, and they're still assuming this kind of profit from here on out.
Now, see, I'm wondering what percentage of their revenue comes from Apple, because remember the same talk was with Intel, and we found out that it was 1%. Remember that?
Yep.
It was pummeling the news. Intel's losing Apple. Intel's losing Apple. We pulled it up in the 10K. It was 1% of revenue.
20% of Qualcomm revenue.
Okay, that's a pretty big chunk.
That is a big
That's
chunk.
a big chunk.
That is a big chunk. Now, hopefully they can replace. Maybe that's a big reason why their revenue isn't jumping up as much as it should in such a fast-growing industry.
Yeah.
All right, guys. So let's check out our stock analyzer tool. Like I said to you before, most popular part of our website. It was used 1.3 million times last year. But before we do that, our software here, everything you see here is available right now in our software on our website, everythingmoney.com. All the tools here you haven't even seen, the community. I just had somebody reach out to me today, said, Paul, I left for a while. I wanted back. I came back, and they paid more money because we raise the price every month. But good news is you can try it out now, $7 for 7 days. That's $1 per day. Try out the software. I assure you, it'll change the way you look at money. We have many developers working on this at all times, always doing updates. But the biggest factor here is this community. thousands and thousands of investors who can sit there and talk every single day about their ideas. I'm sure people are talking about Qualcomm. They can guide you on what they've seen, because remember, guys, investing with a group of like-minded people is so much easier than the other way around. You're going to be much more emotional if you're by yourself sitting there looking at the markets go down. We're here to help you out with that. Everythingmoney.com, $7 for 7 days. But Mo, why don't you go over the charts here on Qualcomm and explain to people what you're doing with the charts?
So the first thing I want to point out, if you're not familiar, don't get discouraged right off the bat. But these lines, these colored lines that I have in here, these are my moving averages. The most notable is the turquoise and the white. Those are my 100 and 200-day moving averages, respectively. And you can see that it's struggling to break through. It popped up, but it's struggling to get through. Volume will drive this thing. If you get volume into this, meaning almost the gasoline to your car, that's when you will get some movement on Qualcomm through the 200. But I would be very careful with that. For me, I would come over here and look at it from a long-term perspective. So there's two different charts that I use. One's for shorter-term trades. One is for longer-term trades. I prefer to look at Qualcomm from longer term, because look at my stochastic. It's kind of moving towards that sweet spot area. If we can start moving up and getting that volume and driving to the top, I could see this stock moving to 140 sometime in the next, I don't know, 2, 4, 5, 6 weeks.
Yeah, that thing is setting up pretty nicely on that long-term
right
trade.
Down here, yep. So that's the sweet spot that we're looking for. You're looking at your trend lines moving into the stochastic, which gives you the highest probability to make money. This could be one to pay attention to.
Yeah, we're constantly back testing different strategies, and this one is back tested very well. And if you're part of the community and you get in this thing, those are the things we kind of release to people to show the extra work we do. So again, $7 for 7 days, everythingmoney.com. So this analysis, what do you want to do here, Mo? Why don't you do a 10-year analysis?
Okay.
Or you want to give me some of your assumptions for let's talk about the assumptions for the 10-year?
Sure, let's do it.
Okay, so revenue growth.
So I'm tempted to start at 3, and the only reason is because we have to kind of maybe taper back from the crazy revenue growth we've had over the last couple of years. 3, 6, and 9, is 9 too high, do you think?
So it seems high.
Maybe 3, 5, and 7?
But I like the idea of doing, 3, 5, and 7.
I think 3, 5, and 7 may be a little more reasonable.
Why don't we do 2, 5, and 8?
Okay.
Because I look at this thinking to myself, okay, I don't mind being pretty aggressive on the high side.
Yeah.
Just to give me an idea, if it's massively overpriced, it'll tell me like, hey, listen,
right,
even at this high number of 8%, you're still not even close to the buy price.
I mean, even over the last decade, with the insane growth that they've had, they only did 5.3%.
I know.
So.
And making acquisitions,
Yeah.
that's my concern.
Yeah, that's true.
All right, profit margin.
All right, so profit margin.
It's increasing here because 10 years is 19.8, but we've also seen this big surge in the last 5 years. So what's a reasonable overall profit margin?
Maybe 23, 26, 29?
See, I don't agree with that.
29 too high?
So Mo, I look at 20 and I go, okay, that 20 includes some of this.
That's true.
So I'm looking at going.
Are you looking to go like more 17, 18 to start?
I was thinking 18, 21, 24.
Okay.
Because I look at this saying.
So you're saying they can't sustain these margins they did the last year?
I have to me, with a proper way to handle investing is to
be conservative off the rip.
But this isn't like unjustified.
No.
This has been dragged up by these numbers right here. Right? So I'm looking at going, okay, they probably made, and they've been adding new companies. I'm like, could I see 24 happening? Yes, absolutely. But could I see 18 happening? Yeah, absolutely. So, okay, what about free cash flow?
Are you thinking the same numbers?
Yeah, probably.
I think for a company like
even though these numbers are way higher than they've seen in the last, but over long periods of time, profit margin and free cash flow should be the same. It should equate out. Now, what about PE, Mo?
About 15, 17, and 19.
See, I agree with that. Now, guys, I want you guys to make note. The current PE is 13, but I don't make my decisions based on the current PE. I look at it saying, this is a high ROIC business. The ROIC is getting better. I look at it saying, okay, if it's stabilized, well, you know what? Wait a second. But what about the Apple? What about the China and Apple stuff?
I don't know.
Why don't we do this, Mo? Why don't we do 13, 16, 19?
Okay. And to me, that's the biggest question mark here is the China Apple stuff. I really need to figure out what that is before I would make an investment.
Yeah.
Even depending what the price spits out here.
Yeah. All right. Now, desired annual return. Now, this part, guys, is the more higher your assumptions, the more margin of safety you need. The higher desired return, the more margin safety there is, because as you get a higher and higher return, you have to pay less and less price. If this phone's worth $1,000, I'm going to make a higher return on investment if I pay $100 for it versus $900 for it, right? Yeah. So the higher my desired return, the more margin of safety. Mo, let's see what you think about this one.
So I'm almost inclined to say 11, 13, and 15, and it's because you brought up the China thing.
I think 12, 14, 16.
Okay. Now that could, if I went to 10K and I figured something out and I was like, oh, this isn't that bad, I can move it to 10, 12, and 14.
Let's do 11 and a half. Let's go in the middle, 13 and a half and 15 and a half.
Okay.
Even though I'm reading a book right now called Never Split the Difference.
Oh, it's a good book. That's
I'm listening to the book. Sorry.
The military guy.
Chris Voss. Yeah. No, FBI guy.
FBI, that's right.
He's like, never split the difference. He's like, when you split the difference, both sides lose.
Get a master class.
He did a master class, correct, yes. Yeah. I think you're telling me to get a master class. I'm like, well, I'm listening to the book right now. Hashtag better than the master class.
Yes.
All right, so I did 11 and a half, 13 and a half, and 15 and a half. Because again, there are a lot of unknowns here. If you see other companies that are big tech companies that we beat up, we would go 10% here, right?
Yeah, and guys, notice we're doing this based on the information that we have right now. So these things will change when we get more information.
Absolutely. We're just trying to see, are we even close to the ballpark?
Yeah.
Hit the analyze button. Boom. All right, low price of 74, high price of 140, mid price of 104. If you paid today's price of 124 and the low assumptions happen, you'd make 3.99%. If the middle assumptions happen on today's price, you'd make 10.88. And if the high assumptions happen, you'd make 17.55. So I'm going to add this to my watch list at, I'm going to say, I'm not desperate to own this company. I'm going to call it $80.
Okay.
So now it's going to notify me on the email, software, and the app, my phone app, when the stock prices hit that, and I'll just wait patiently.
Yep.
So guys, thank you very much for your time. Again, everythingmoney.com, $7, 7 days, $1 per day. It'll change your view of money. Thank you.